Hi, everyone. Thanks for joining us at the Social Enterprise Summit. My name is Johnson, your moderator today. I am a policy researcher of our Hong Kong Foundation, an independent think tank dedicated to promoting the sustainable and long-term development of Hong Kong. And I'm leading the foundation's work on sustainable finance and social innovation. Our panel today is titled Collective Impact for Environmental Sustainability. Obviously, the keyword here is collective, which echoes the theme of the summit this year. I want to set the stage by reflecting on the most devastating incident this year, the pandemic. So scholars from different institutions have pointed out that one of the keys to preventing the next pandemic would be to reduce deforestation, as novel viruses like COVID are more likely to jump from wild animals to human beings and people when we continue to remove the forests and destroy the natural habitats. And if you think about it, it is a classic collective action problem. It takes not just one or two of us, but all of us to resist the temptation of the immediate economic benefits of cutting down the trees in order to avoid the tremendous cost brought by a pandemic and paid by the people as a whole. This is extremely difficult as the social cost is not priced into everyone's decision. And clearly this same problem is sitting at the core of many other challenges like climate change. And I've always been wondering how we could possibly overcome this hurdle. And this brings us to our panelists today, who will be sharing with us in a minute their reflections and work on collective impact for environmental sustainability. Today, we are pleased and honored to have Dr. Antela Benz, CEO and co-founder of Intenso, and adjunct associate professor at HKUST Business School. Dr. James Gifford, head of impact advisory at Credit Suisse, and Mr. Neil Yeo, CEO and founder of 1.5. Thank you all for being here. And without further ado, may I now invite Antela to be the first speaker to share with us your work and thoughts. Antela, please.
Thank you, Johnson. Thank you for having me here in this panel. It's my pleasure to share our work and thoughts on climate change and climate risk and how we collectively can achieve climate mitigation and adaptation to this big issue. Okay, so there'll be 4 topics I would like to discuss today in 10 minutes, so very briefly going through environmental issues we are facing, the current market awareness, number 2. Then I'll jump to climate change risks. What are these risks and how we can enable solutions for collective impact. Just a brief introduction, as Johnson said, I am the CEO of Intenso. So this is a startup, 1.5 years old, which tries to tackle exactly this. So how we can bring climate risk solutions to companies as well as to retail investors. That said, my background is on ESG and impact investing, starting more than 12, 13 years ago here in Hong Kong. So there is a deep desire from our company and me personally to make ESG and climate change solution and able for companies, so to make them practical for use as well as relevant so that we can all act fast enough in today's environment. So let me start with environmental issues. There is not a single day we don't hear about typhoons, whether they go through Philippines, Vietnam, or Central America. So in other words, the severity and the frequency of this typhoon has increased. Floods in China during June, July, and typhoons, overall these 2 events, they cause more than 80% of the damage from climate events. The losses are huge. They go between 250 to 300 billion US dollar per year. That's 4 times higher than 1980s. So in 40 years, we have 4 times bigger losses. The worst is that we project to have 3 times more losses in less than 10 years. So there is emergency and urgency to act right now on climate change. So what is the current market awareness? How does the market look at climate risk and climate change? I'll put it very bluntly, carbon. So carbon risk is climate risk. From my understanding of my research, as well as what I see in the market, it is not entirely true. So carbon is the cause. So because of carbon, you have climate change. However, to say that carbon risk is your climate risk, you're reducing these losses, this risk to a very minimalistic state. So we should look beyond carbon, and I explain why. Companies have now embraced ESG. So most of the companies will be disclosing on ESG. By that, I mean on E, S, and G. And within E, they'll disclose on carbon footprint, they'll disclose on water, recycling, waste management, etc., etc. So that's this environmental footprint we look at in ESG. Now, because of carbon and water, the way we treat the environment and how much we pollute, we have caused, to a certain extent, change in the climate, in the way that the physics works, in the way that the air temperature and the sea level rise, and all this, they are combined together. What we don't do, we don't measure yet physical, social, and economic damage due to climate. So while ESG is the endogenous factor, is what we do to the environment and society, the climate risk is what the environment is doing to the company, right? We start now talking about physical and transition risk. These are the initial steps, and companies will have to start disclosing that, but yet we have to measure this, right? So if you don't measure climate risk assessment, we don't know how much a company's cash flow will be damaged or will be impacted. We don't know how to address, if you don't measure, you don't know how to mitigate. So these risks are not priced in the market. And because there's lack of transparency on this new risk, I might call as well a new risk that we're facing today, the scope for climate finance, for green finance, we can say that is not easily achieved by 2030. So what do we need to do? We need to create the link between ESG and climate finance. Okay. To put it in a broader perspective, many of us have seen this chart. It connects the CO2 concentration with global warming by 2100. So the more CO2 and equivalent we have in the atmosphere, potentially the bigger the damage, or the more catastrophic are the consequences we are facing, both in terms of business as well as society. So these are different RCPs, leaving the terminology aside. The red one indicates a global warming between 3 to 6 degrees, RCP 4.5 between 1.7 to 3.2 degrees, and RCP 2.6 between 0.9 and 2.3. We like to be on the blue line, however, it's quite difficult, and we need drastic measures to start, not just get introduced in the market, but we need implementing these measures as of now. So there is quite an urgency for climate risk mitigation. We estimate there are around $100 trillion assets at risk, but at high climate value at risk, there will be around 43 trillion. This again is very conservative estimate. In Asia, we talk about 4.3 trillion asset under high climate risk. And what is important to know is that not all countries will be impacted the same way. You have countries which have high climate risk, but the economic level, the level of preparedness is high, so they can withstand climate risk. So we compare frontier Asia, emerging market versus advanced Asia like Japan, Australia, and New Zealand. The impact of climate on their economy in terms of GDP will be different. So there are different elements of climate. And that chart, and that these slides will be able to show that. For example, in Greater Bay Area, we have 5% of population, China population, which produces around 20% of the country GDP. So economically, very important for China, but very highly populated. So density of population is very high. Climate risk is as well very high. So by 2050, according to this study, around 30 million population. So you have 30 million in China alone, which lie in low-lying areas. So they will be at very high sea level rise. So basically, you'll have huge economic as well as social costs. So what do we do about that? You need to enable climate solution. We need to see how much risk we have. We need to measure this risk. We need to see, like, for example, in China, you have the coastal side of China there. You see, these are all the typhoons that land in China. We can study past typhoons. We then can model typhoons, including the climate change implication, and see how many typhoons and what will be the severity of these typhoons in the future. So you avoid concentrating the population or building in areas of high risk. One can look at flooding risk. This is, for example, Yangtze River and Wuhan Center here in the middle. There are solutions in the market which makes it available and readily, easily to see how much risk you have in these areas and where the risks come from and how it can potentially mitigate this risk. When you talk about climate, again, I'm coming back to the point of a Greater Bay Area. Climate risk is one thing. The other is economic exposure, is a population density, is economic value you generate in that area, is urbanization. And then you come up with a dollar value, the climate value at risk, how much risk you have because of your exposure to that location. So we need to figure out, we have to create a link between the three. We cannot just talk about climate without giving a dollar value, because that's only the language that financial market understands. So if you want asset allocation to integrate climate risk, we need to make these solutions available. And then the last two slides, this solution would be, should be available not just for the business, but also for any individual in society. We need to make it clear to each of us that climate risk affects us as well. If you buy a property, you need to know how much flood risk you have, how much landslide risk, how much storm surge risk. These elements are already being priced in US market, and soon you'll have it across many countries where these solutions are available. So only by enabling these solutions, we are able to measure climate risk, act upon climate risk, not just from business, but also as a community as a whole. These are just examples of how one can display these results to the outside, business as well as community. So in a nutshell, and it's not just business impacting the environment, but also the environment impacting us. And we need to provide both measures on ESG as well as climate to make, to come up with sustainable solution which will reduce the risk of society to climate change and climate risk. Yeah. Thank you. That's from my side. Yeah.
Thank you, Antela. That's very insightful. I think it's really interesting because we just talked about like the carbon price may not be material today. It may not be sufficiently high today. So these risks may not be material today, but like if we can actually integrate the climate risk into our pricing, if we actually price in the risk today and also the potential like social costs like in the future, like we could actually use finance as an amplifier for like moving the needle today. And that would actually create behavioral shift that is meaningful for contributing to environmental sustainability. So that's very interesting. And next, let's hear from James. James, I know you won't be using slides in your presentation, but I know like you've recently published a paper on the double delta of impact investing. So can you share with us what it is about and what is your thoughts on this topic today? Thank you.
Yeah, thanks very much. And I'm delighted to be here to speak about this today. So I just published a paper with Credit Suisse called Double Delta, delivering impact at both the company and the investor level. And before I get into the concept, I just want to give you a little bit of my background. So I started in an NGO in Australia called the Wilderness Society around 20 years ago. And at the time, there was really mostly just negative screening or exclusions was the approach of the sustainable investing industry. And that involved just not owning a number of sectors like tobacco, gambling, pornography. But I thought to myself at the time, but does that really make a difference? Does really making not owning some sectors really make a difference? So back in 2003, I actually did a master's thesis where I compared negative screening or exclusionary approaches to sustainable investing with shareholder engagement and activism. Now, shareholder engagement and activism was only happening in the United States. It wasn't happening in Australia or Europe. But they were the two main types of sustainable investing 20 years ago. Now, microfinance was just starting. There was a little bit of renewable energy, but not much. So it was really the bulk of the industry was doing this negative screening. And I looked at the evidence of when companies get kicked out of the S&P 500 simply because they are the 501st biggest company in the market. Now, you would think that this would be the dream of the sustainable investor, because when you get kicked out of the S&P 500, you would lose more than a third of your shareholders forever. And there's a huge divestment effect. And so this, if you could replicate this in the socially responsible investment sector, then in theory, you should be able to make a big impact on these companies. So what they call block trades, when companies move in or out of, for example, the S&P 500 or the FTSE 250, this is a natural experiment of what happens when we divest companies. And the result is that the shares are trading at exactly the same after a couple of weeks. So think about that. These companies lose more than a third of their shareholders, and yet it really doesn't make any difference to the share price. Now, that is a very profound realization, and it was for me. I then looked at the history of shareholder engagement and activism, which is where shareholders use their power and influence to push companies directly through dialogue or filing shareholder proposals at a company AGM to improve their sustainability performance, implement policies and procedures and proper governance. And I found a 30-year track record of success and real impact. And I thought to myself, wow, not all sustainable investing is created equal. And we need to talk about this a lot more. So this is back in 2003. I then went to the United Nations and founded the United Nations Principles for Responsible Investment. It started as an intern project and turned into a 10-year career. I was the first employee and built up that organization until 2013. And then went to Harvard and set up a course on impact investing for ultra high net worth next-gen family members. After that, I went to UBS as head of impact investing and now to Credit Suisse as head of impact advisory. So what did that journey teach me? That we have to think of impact in two dimensions. And this is the double delta concept. Delta meaning change. We need to think about change at the company level and at the investor level. So let's dig into this a little bit more. What does it mean to have change at the company level? Well, this is what everybody talks about, the impact that a company has on the world. Are its products saving lives? Is it if it's an EdTech application, is it successful in helping children learn? If it's a healthcare application, is it successful in improving years of life or treating disease? If it's a fintech app in a developing country, is it successful in providing financial services to the unbanked, to the people who haven't had access? I would say 99 point something % of the discussion of the impact of impact investing is focused at the company level. All of the metrics are all focused on the degree to which companies make a difference to the world. Now, if I buy shares in Unilever, a large cap listed equities, does any of that money go to Unilever? No, that money goes to the person I bought the shares from. And if I can buy shares all day long and it will not affect the share price of Unilever, unless I'm some activist hedge fund in New York or, you know, Warren Buffett or something, you are not going to affect the share price. Now, even when the Norwegian government pension fund divested from Walmart, they did it over 6 months, dripping out the shares using 8 different brokers, specifically so they didn't affect the share price. Because if you dump all your shares on the same day, then you're going to have to accept a lower price for your shares. So you can't have it both ways. Either you have an impact and lose money because you're dumping your shares and you lower the share price, or you drip out the shares very slowly, you don't affect anything in the world, and you get the best price you can for your shares. So you see where I'm coming from here. The more liquid the strategy, the less impact there is. The less liquid, the less efficient the market, that is venture capital, private debt, developing countries, the more impact you will have. And this is a very powerful paradigm. So Delta 2, the second type of Delta, is investor impact or investor contribution. We have to look not only at the impact that the company is making on the ground, we have to look at the impact that the investor is having on the company. And there's only 2 mechanisms of investor impact. One is financing the company in its early years. So that is injecting money into the company through venture capital, private equity, private debt, you know, unlisted real estate, that sort of thing. And the second is shareholder engagement or active ownership. And that is using your power and influence as a shareholder during the investment period to influence and push or help that company improve. And those are the 2 key mechanisms of Delta 2, which is the change that investors can make onto the companies and help them grow faster, which then can make more impact on the ground. So I want to give you a final analogy here. Think about a guitar amplifier, you know, with all of the knobs along the top. Now they have like 20 or 30 different knobs, and most of the knobs, you know, tone or bass or treble or whatever, I see them as the impact metrics that most people talk about. You know, kids in school, you know, health outcomes, jobs created, all really important. And fine-tuning those knobs is very important. But on the end, there's one called master volume. And master volume goes from 0 up to 10. And it determines what all of those other knobs do in terms of output. And master volume is investor additionality. And if you're doing venture capital or seed stage and you're catalyzing things, then your master volume is up to 10. And then the later stage, the company, the more mature, once it goes into listed equities, mid cap, large cap, your master volume goes down to 0. Thank you.
Thank you, James. This is great. Like the distinction between investing in impactful projects and actually creating investors' own impact. So I think this is very, very important and very insightful point. And I would actually love to like share a little bit more about like the similar development, not just in like private equity or the private market, but like similarly in the loan market, we also see similar development, like the development of sustainability linked loan that actually where banks use the margin reduction to incentivize companies to improve their sustainability performance. So it's not just about what you invest in or what projects you lend to, it's about how you engage the companies, how you engage your clients to create the impact. So finally, before we kickstart the panel discussion, Neil, can you share with us your work of 1.5 and how it contributes to environmental sustainability? The stage is yours.
Absolutely. Thank you so much, everyone. And I can see a lot of the overlaps between both of your works. I'm the CEO and founder of 1.5, or opf.degree is our website. I'm also an impact investor as well, deploying capital from Australia into Asia Pacific and also into the US. So what James said was very relevant. But I wanted to share you about who 1.5 is, or what we're about. Well, our core vision is to accelerate solutions that enable business and environment to co-live in harmony, to ensure that warming stays below 1.5 degrees Celsius. And for those on the call probably well know that 1.5 degrees Celsius is the level or the warming that we need to keep under from pre-industrial levels to avoid higher climate risks or climate catastrophe. And so we felt that was very reasonable to have this as our North Star. But why do we exist? Well, business emissions are very substantial. The Carbon Disclosure Project found that it was only 100 companies that generate more than 70% of global emissions. Global warming has reached a threshold. It's already 2/3 of the way to 1.5 degrees Celsius. We're now seeing that 83%, if not more than 100% now, given new reports coming out in 2020 that, and Taylor would probably be knowledgeable of from McKinsey and things, that physical and financial risks of climate change are real. And there has been a huge appetite to figure out or measure that and figure out how they can adapt. And also that the time is running out. We really only have 10 years to halve emissions. And that kind of really started my journey. But I'll share that more later on in the stage. Basically, our mission is to democratize access to multidisciplinary experts to develop and deploy these solutions. And I say this because right now, these experts are not democratized. It is broken. So when we try to access experts, the system is actually broken. And as an ex-consultant, they say you're a recovering consultant. Traditional advisories generally, they hire generalists, these A-types, so you can imagine the McKinsey, Bain, BCGs. They place them into companies and they think, well, if you're smart enough, you can figure it out. Unfortunately, what that means for companies is they're charging very high costs for these experts or generalists to pay for the overheads, and there's less pay that goes to the generalist. And generally, when it comes to sustainability, because climate change is very complex, and you can't just solve it from a business expert, companies generally lose out on profits and sustainability targets. But 2020 has changed potential access to expert talent. COVID has shown that remote working is becoming a new norm, and it's possible to do this. In fact, our webinar right now, and the way that we can collaborate. An economic recession always shows that there is less demand for high-cost traditional consulting services, and there's a gig economy norm that's coming up, especially in younger professionals, but across all paths, that people that are experts, even with full-time jobs, would be willing to sort of work on expert work on the side, to freelancers becoming much more of a norm, with solo entrepreneurship really driving millennials and even Gen Zs in the world. And there's also broader priorities that companies are going to want. When it's a bullish market, they're happy to spend a bit and sort of see what they can do for sustainability, but push comes to shove, it's going to be about resiliency and survival, and also achieving the targets, which we have heard from many different companies that they're not pulling back from their targets, so they're going to have to do more with less. So that's why we exist. We exist to democratize access to experts. What we do is we leverage these new trends that are coming up to vet experts of multidisciplinary areas from business, science, and technology. And we place these experts at lower costs into companies, given the fact that we are remote, with lower overheads, and give fairer pay to our experts whilst bridging the gap for companies to achieve both profitability and sustainability. But how do we work? Well, we've been working with about a dozen clients since the beginning of the year, and people say you're crazy starting a business during COVID, but I think you never take waste to a crisis. And we worked with a consumer product company that really wanted to do eco-toxicity, as well as impact reporting in an investment case. So traditionally, a lot of sustainability advisories are very bespoke and boutique, and that's because there's a lot of minor specialty areas that you need support from, and it doesn't make sense to have costs or these experts on your salary roll if you can't place them all the time. But through the Yale network and also through the company networks that I have, we're able to place a green chemist, environmental engineer, and a climate finance expert for a fixed number of days to actually execute on this project. And that was allowing us to solve what is multifaceted, which is a multifaceted problem, which climate change is. And so we have a step process where you can request for us in terms of a project, And then we actually mobilize the experts from our network. We propose the expert, the timeline, and we manage the experts alongside your team. So it's actually the idea of working alongside you rather than just consultancy. And we also work with departments, almost like an entrepreneur in residence. And the reason why is because I've been there. So I have a background in robotics engineering all the way back in Australia to basically working management consulting for you name it. Accenture to a McKinsey startup that then got acquired by KPMG. And then I worked with Dalberg after my MBA at Oxford in like off-grid solar and agri-tech before taking on an impact investing job for venture philanthropy with Echoing Green in New York, writing for Forbes on climate change solutions and with the World Economic Forum. I noticed that climate change from one aspect or one expertise is not going to solve for the problem. We need collaboration. Even with the UNPRI or other initiatives like that, even the Paris Treaty, they wouldn't have been possible without the mix of business policy and other types of experts. So why can't we access these experts for the problems that we're trying to solve for? And our team is diverse and proves that point, that we can utilize a mix of these talent in order to achieve the impacts that we need. Ironically, the latest project that we worked on, because of our lower cost, we're able to work with earlier stage startups and we can work with leading technologies, which allowed us to actually work with a London-based climate physical asset risk, machine learning and AI platform. Not only running due diligence for a family office to make an investment, which mind you, when you're talking about investments into early stage, I can tell you there's a lot of family offices, foundations that require skill sets to be able to look at technical due diligence. So for example, even private equity, when you're looking at battery recycling technology, having a battery chemist or an environmental engineer to be able to discern technology is extremely critical. So we've been finding that we've been able to apply this in many ways other than just Fortune 500 companies that may just be doing a CSR ploy. So who do we have? Well, right now we're a mix from advisors to techies to engineers to scientists. And we've identified 8 core areas that at least we do have expertise in and really are using the hypothesis of, there are many problems in climate change, but what would a collaborative expert network be able to solve best for? And these amongst the biggest issues are the areas that we sort of see are important. Climate finance investment is upcoming, and I've seen some very inefficient deployment of capital across different asset classes, even as a personal investor. Data and technology is extremely critical for our future in terms of disruption, clean energy and storage, reducing the variable network and the cost of storage, circular economy, industrial, and so on and so forth. And so we really are trying to get that depth and breadth of experience that you otherwise wouldn't get elsewhere, have these people at the go, not necessarily under our payroll, but with a willingness to work with a core team. And so we have obviously our core values and philosophies, and this is our office. So the idea is, the concept is that we've been able to do majority of our work remotely. In fact, I didn't even meet 2 of my team members from Yale until the end of the summer when COVID kind of eased, and was surprised at how tall and short they were and all that. But, there's very possible to do work and at low cost. And our partners recognize that as well. We see that we're not going to do this alone. We don't want to come and develop Excel sheets or PowerPoint. We've been looking at climate software solutions or technology players to partner with, noting that even if we come to a company, company readiness for climate change solutions is very varied. So say, for example, Equilibrium out of Taiwan and Singapore, they have an ERP software solution for sustainability tracking. So imagine you kind of log on and you can see your dashboarding for your sustainability tracking, but you can create reports that are linked to SASB, TCFD, GRI, and get away from Excel. Well, they can't really do that just by implementing it because companies are not that integrated. So we become the integration specialist and testing that out. And so far, so good. We have a lot of case studies, which we can 100% share. But this is us, 1.5. If you're ever looking to partner with us, let us know. We've even talked to the Hong Kong government in terms of the infrastructure side of things, because we might be able to support them on a few sustainability initiatives there. And I guess I'll show you one last thing. This is one of the case studies that we did, running a due diligence on a climate change machine learning AI platform. We looked at all the competitive analysis, mainly across in the US, across the world, I probably will talk to Antella about this as well. And we're assessing the real potential for market entry to the US. And later on, we actually became the partner to look at the US market entry and customer lead generation, which led us to a whole bunch of conversations with Blackstone, BlackRock, even Credit Suisse, Morgan Stanley, all these financial services impact leads across the US. So more than happy to share on that. But yeah, I'm glad to introduce us as 1POINT5.
Thank you, Neil. You made a great point that So you made a great point that it is obviously insufficient to have just a single expertise to address the climate change challenge. And we are obviously treated today to have a panel of very diverse expertise of speakers today here. And thank you all again for all the presentations you made. So now we are into the panel discussion. But before that, I would like to invite the audience to submit your questions using the Q&A function of Zoom. And then I will direct the questions to our speakers during the Q&A section. So now let's get started with the panel discussion. To start with, I think we would all agree that a sustainable environment would benefit us all and it would provide rich soil for businesses to grow. And one of the key challenges to ensure that we have such an environment is the discrepancy between the social benefits and individual benefits, or put simply, whether it pays to do green. So James, I'll come to you first. What is your view on this potential trade-off between environmental impact and financial return? While there may be some high impact projects with competitive returns, do you think we have sufficient of such opportunities in the market so as to ensure environmental sustainability of the world as a whole?
Yeah, so there's a few questions there. The first is, if you're an investor, there is absolutely enough sustainable and impact investing fund solutions and investments out there that you can now have a 100% sustainable portfolio across stocks and bonds and alternatives, private equity, green real estate, infrastructure, private debt, venture capital, and direct investments. Not so much in hedge funds and commodities yet, but you don't really need them for a diversified portfolio. So there is more than enough now. I mean, we can, if a client walks in, to Credit Suisse, we can deploy $1 billion into sustainable and impact investing tomorrow at the same expected risk return as any traditional portfolio. And you couldn't say that 10 years ago. So this is, I think, a huge step forward. Now, whether it's enough to create a sustainable economy, absolutely not. You know, there's a lot more that needs to be invested in. We still have 1 billion people who are living in poverty in the world, and they require significantly more capital and investment to build up those economies. We have a massive carbon transition to undertake, and that will require significant additional investment, not just in wind and batteries and those sorts of technologies, but a lot of areas that people may not like mining. I mean, mining is going to be a really important part of the future. And so we have to get mining right. We have to make sure that we can mine in sustainable ways and that we don't pollute rivers, and we look after local populations, and we have rehabilitation of mining sites. But no, there's definitely not enough money going into this space now. But if you're an investor, there is more than enough to invest in.
Thank you, James. So now, Antella, if I may come to you now. So you've just talked a lot about ESG and climate risk, and which are obvious to have financial implications for companies and investors. So my question for you is, does it pay to manage climate risk in terms of both costs and benefits? And also, to what extent do you think this contributes to environmental sustainability?
Yeah, absolutely. So that's also the difficulty when we try to sell climate risk solution to a party, be it a business or a VC or investor who has not been faced with climate risk the way we want them to see it. That said, if you talk to a Singapore company, they are not so aware of climate risk because they don't see typhoons and floods. But if you talk in Hong Kong or in China, they know what climate risk is. Now, so climate risk is risk, right? So risk means that it goes up and down. So you have deviation, you have volatility, right? So risk on the upside can be opportunity, and on the downside is a risk, right? So you have to manage this risk. So climate has, it takes, and from also my presentation, it takes a negative connotation, right? It is true, but you also have opportunities. You have both climate risk and opportunities. Let me give you an example. For example, take a real estate developer, we working in Hong Kong as a conglomerate, wanting to invest in Jakarta, and they have 3 locations in Jakarta. What we do, for example, we run all kind of climate risk assessment and in detail flood assessment. So you can see exactly how much flood they will get in under different RCPs or 2030, 2050 from now, which means not just property damage, but also business interruption because you cannot enter the building, right? And all these associated costs. So the owner, the property developer is, right now he knows which place is the best one to allocate the resources, you know, where to invest and where not to invest. And if he decides to invest, right now he knows where to build the flood walls because you can see the flood comes from the northeast or from south, etc., etc. So this is the use of climate risk solution, which enable them to adapt to climate. Not always you can get rid of climate risk. You also need to adapt. It's a mindset. We need to adapt. We cannot mitigate fully the climate change because what is done is already in the system, is already in the atmosphere. So there is need for adaptation. Take wind farms. We talk about what, $250 billion investment in renewable energy. You can put a wind farm in India, but then if you do the climate analysis, you see that jet streams will be weakened over the next 5-10 years. So you'll not be able to generate enough energy and means revenue. So it is a risk. So you have to use climate risk, not just for disclosing to your investor and regulators, but also for increasing your revenue or your return on investment. So it's a real bottom line. It affects your cash flows in a very meaningful and impactful way. And it's very visible. You don't have to wait 5-10 years from now. It already impacts your sustainability right now. So yeah, so it is, again, I repeat, it's not just for disclosure. Climate risk assessment, it should be a must for, I think, for most of the companies. I'm not saying all will have to do it. Some are at risk, some are most at risk, but it's good to know your risk and it's good to know to manage your risk and as well as opportunities. If you don't know, then you don't know the risk of your risks. Yeah.
So now, Neil, I'll turn to you. So how do you view the relationship between impact and financial return? And also, given all your experiences in advisory, what would be your advice for our young social entrepreneurs in turning an impactful project into an invincible opportunity?
That's a good question. When it comes to impact and environment, it's a tricky road. I think the existing systems and paradigms that we have right now are not set up to solve for climate change. So one key example that I would sort of say, if you look at economic growth, we know that neoclassical economic growth says that economic growth equals consumers plus investment plus government spending plus net export. I remember talking to a friend of mine who's a climate expert and saying, you know, we've never taken into account the negative externalities of the economic growth that we've created. And he said, it's not externalities, it's that we've misdefined the whole entire system itself. When we defined neoclassical economics, we thought that we could never do anything to the earth that would be irreversible to having the same standards of living that we have today. But it's clear that technology and consumerism and even our populations have gone past that level. So when we think about it, you know, China having double-digit economic growth for 2 decades, that's very much defined in our archaic system. And so I think the first thing that needs to be identified when you're thinking of impact and environment is trying to shift your paradigm of thinking beyond the existing systems that kind of help to generate us or bring us to where we are from the Industrial Revolution. And as soon as you can do that, yeah. Sorry, James.
Oh, no. I was just going to say, just for the sake of playing devil's advocate, look, I think you try telling that to a Bangladeshi garment worker who's got their first job in a factory, which is double what they were earning when they were up to their knees in mud in a rice paddy. I mean, seriously, China has pulled more people out of poverty in a shorter period of time than any other single event in human history. And that was pure, rampant capitalism. So yes, we have to make it cleaner. But I think we need to recognize there is no other solution which has ever even gone close to industrialization, not even close, nowhere, not one experiment, not Jeff Sachs and the Millennial Villages Project, not one experiment in the world has ever even got close to capitalism in pulling people out of poverty. Now, we need to create a clean capitalism and we need to develop better technologies. But even if you look at the material intensity, we're getting better and better and better at producing more with less. Now, again, I just feel I worked in the apparel industry in Asia for a few years and did a lot of consulting in factories. And I think there's a lot of, people, especially, in the West and intellectuals who don't really spend much time in those factories, don't understand the apparel industry itself pulled all of us out of poverty, whether it be Australia 120 years ago, Boston, New England, Industrial Revolution, Manchester. It was actually the apparel industry and pretty appalling labor standards and pollution that allowed us to build what we're building today in terms of wind farms and renewable energy and the wealth to be able to solve these problems. So I think it's really important that we understand that economic growth, yeah, we can tweak the definition, but to challenge economic growth fundamentally I just don't see any other alternative.
Yeah, no, thanks for mentioning that, James. And I was using this, I guess, as an example and probably extenuated it, not against capitalism, because I myself am an impact investor. And if anything, I'm invested in this system itself. But I guess James says an absolute right point, that there is no perfect system, but capitalism has kind of created our livelihoods today, that we've never had the same standard of living. And in fact, I've also been in Kenya and sort of seen some of the early stage manufacturing of things. But I guess maybe the concept that I'm trying to say is thinking a bit more not having to sort of take the norms as they are when you're thinking about innovations or new solutions, that we don't need to sort of do things in the same way, but our existing industries have allowed us to create that. And we're using those industries obviously to try and solve for the problem. My question is, will that be enough, at least from when it comes to access to expertise, access to sort of technologies? There is a report that I wrote at Yale on investing in nascent climate technologies. And James touched on the point that if you invest in non-efficient markets, that's where you can have the biggest impact. But unfortunately, sometimes the capital efficiency of getting that money to these early stage startups can be very difficult, because our traditional venture capital, Silicon Valley, so I'll be very specific, they have a 5-year period of investment expecting double-digit growth. But when you're investing in, say, hardware technology like climate negative emission technologies, or technologies that require research and development dollars, market risk and technology risk, it's not a very traditional investment for a venture capital investor to do. However, there's extreme amount of work, especially with the UNPRI and all the development of these new tools. Like in the US, there's mission-related investments, program-related investments. There's donor advice funds that are now used in many different ways, with the Rockefeller Foundation giving out risk-tolerant patient capital. But we do need to sort of evolve some of the aspects of capital flows, expertise provision, in order to solve for that problem. So yeah, absolutely nothing against capitalism, especially with the Hong Kong audience, where capitalism obviously drove Hong Kong's growth in the last few decades. But definitely there are new ways that we can think of solutions.
Yeah, absolutely. If I can just chip in, that's sort of my message before. We don't need to change the system and go back in the old days, but we can make a more efficient capital allocation. And the way to make it in the market, you need financial market. You need financial market to understand the climate risk terminology. What does it mean? So we need this mechanism to link the two. We need to price in these risks. So you need the climate, what I call climate risk enabler, green enabler solutions. And this is, as Neil said, it is a heavy technology, deep expertise in climate, or it's not easily brought in the market, or companies cannot develop it themselves. So they need deep expertise. So what we need is to channel this information in the market and let the investors take the decision as before. It's just additional information. They have to count it in their maximization profit formula. And profit is return plus impact. Impact is information already embedded in the risk opportunities you have related to climate, whether it's carbon or water or waste or just typhoon and flood, it's all there. But you make it available to them to decide and what's the best interest according to their value system.
Should I grab one of these questions?
Okay, yeah, I think this dialogue is growing increasingly interesting that I feel like we should actually have an extra hour for that. But it seems like part of my job as a moderator is to keep us on time, and I'm conscious we are running out of time. So perhaps let's open the floor to our questions, and I can actually see questions coming in. So we have a question about what we just discussed, about how we should actually reform capitalism fundamentally. So there's a question here saying that, okay, there's a saying that you can't teach an old dog new tricks. So to challenge economic growth fundamentally is to change its principal actors and emphasize the legacy of liability that neoclassicalists ignored. So how would us enable young people to become experts in this field? So does anyone want to take up this question?
The first thing I'll say is that I opened a can of worms that I probably shouldn't have. And as two Australians obviously having a debate, it's kind of key for us anyway. Maybe I might answer this, but answer the question at hand. I'm not trying to challenge economic growth or the fundamental side of it, but for young people here that are trying to be experts, I think that's the question that I see that's applicable here. I get it. We have a lot of people that come to us that are early graduates or are early on their journey, and they don't know exactly what they want to do, but they want to do something impactful. And there's a lot of either people in corporate or in generalist impact roles and wanting to get more specialized, but still figuring it out. I think that this is a real fundamental, it's not a problem. I think it's a nature that young people need time to figure out where they want to invest their time and energy. The COVID crisis has made it particularly difficult, especially for younger people with less experience and jobs and roles. But there are training programs and ways to sort of figure it out. And at least what we're doing in 2021 is we're thinking about an experts to be channel or route where we can bring in not only people that consider themselves experts, and even in millennials, there are a ton of people who don't consider themselves that because of what do you call it, imposter syndrome. But we are creating a training program in order to bring our experts together to do brown bag lunches with experts to be, and in order to allow them to be able to do or learn about areas that they could contribute to. And that we need more people to do it. We can't just have senior executives doing all the work. We need younger people also to help with research. And I think talent is key to our business growth, and that's where we're investing next year.
So we are having another question here in the chat box. So the question is quite straightforward. It's about how do we avoid greenwashing? So we hear a lot about sustainability. We use the word sometimes even a little bit excessively. So how do we ensure that when we use the word ESG, sustainability, green, etc., we are really doing something green or sustainable? Take that question.
Let's say like that, when there was a question before whether ESG brings value or not. 10 years ago, we had to explain, or maybe 5 years ago, we have to explain, yes, it does generate higher return for risk. Moving forward in the last couple of years, then this question was not raised anymore because there's so much talk about ESG. So everybody embraced, the mainstream embraced ESG. The last year, especially COVID, then we come back to this question because we have outperformance of ESG related funds, and whether it is technological, just sector tilt or not, or is ESG. So the question can be raised. Bottom line, it does outperform. Now, why you have greenwashing? Well, because it's, we know, it's at a high, it needs expertise It's investor demand, the regulators putting pressure on it, and clients demand, right? So there is money to be made as well in the ESG. How do you avoid? For that, you need deep expertise to know who is doing what and how they incorporate ESG. But to go to the core of the issue, when you do climate risk, for example, you can't do greenwashing there. For example, if you do climate risk assessment, is what the environment is doing to you. And these are risks which are assessed using third-party data. These are not company data. These are NASA data, satellite data, academic papers and models. So there is little greenwashing there. So with us moving from impact, ESG, climate risk assessment, and this kind of melting and overlapping, there will be less room for greenwashing. It will become much more objective and subjective. Not just companies declaring what they do, but third parties saying what the companies are doing in a much more objective way. So you have to have both sides.
Thank you. And before we wrap up this discussion today, I really want to direct this question to James as well, because you talk a lot about activism and also engagement. And when we talk about greenwashing, it's usually more about like the use of process. Like we see some scandal of like ESG fund investing in fossil fuel. So in the space of shareholder activism and engagement, so what would be your view on the notion of greenwashing? James, please.
Well, I think the most important thing is if you're investing in fund strategies, number one, you want fund strategies that are doing some shareholder engagement and are reporting against that. But I think reporting itself is probably not a perfect indicator, but it's certainly an indicator that the fund takes it seriously, because a lot of funds are not reporting really at all. So if you see funds that are reporting in detail on the SDG mapping of the products and services of the companies they're investing in, and they've got shareholder engagement reporting, look at how they're voting on annual general meetings on sustainability issues, I think you can see it's a reasonable proxy for which fund managers are taking it seriously.
Great, thank you. So we are running out of time, and to wrap up the discussion today, can I now invite all our three speakers to conclude the discussion today with one or a couple of sentences to summarize the key insights or key takeaways for our audience. How about we start with Antela, please?
Well, the summary for me is very simple. There is a lot of talk about ESG, climate risk, climate change. We need to move from a high level talk to a ground level, provide the tools and mechanisms for companies to enable them to act on climate risk and mitigation. This is the biggest risk we're facing today. So we need to be more practical and more solution driven, especially on climate. Yeah.
Thanks. And can we have James' thoughts and conclusion on today's panel?
Yeah, so I think the key point I wanted to get across is this idea of double delta. That is, you need to look for change at the company level, but you also need to look at change at the investor level. And to what extent is your money actually making a concrete, direct difference in the world?
And Neil, how about your final words?
Yeah, my words would be to the audiences here that are in business, whether you are senior or young in your business, climate change is going to need people from all aspects of business, science, and technology. And regardless of whatever field you're in, whether you feel like a generalist and not an expert, or an expert, not a generalist, regardless of that, there is a part that you can play. And so if you're able to find the right company, I would lean into it using a hypothesis or the gut of what you feel you're most passionate about, and that will evolve and change over time.
Thank you, Antela, James, and Neil, for all your insights. And I'm sure it's been a fruitful section for our audience today. And before I finish the section, I would like to encourage our audience to fill in the survey. I believe our staff will put a link at the chat box very soon, or you can use the QR code here as well. And your feedback will be very important for us to improve SES in the coming years. And so that's a wrap for our session today. And I hope you all enjoy the rest of the Social Enterprise Summit. Thank you.
Thank you.